Today, we're doing things a bit differently. Instead of my usual deep dive into risk, growth prospects, and detailed financials, I'll be taking a top level view of Alphabet and the parent company of Google. So, I have been doing a bit differently previously before, so I wanted to try this new approach and by keeping things a bit high level, clear, and easier to follow. Uh, so we'll focus on key metrics such as valuations, market context, and give you a quick yet meaningful snapshot of stock that we will be evaluating. So this is just tells you like my methodology into the valuation model that I'm using to calculate the stock price. And these are some of the mathematics formula that I used and incorporated to make it very robust. I don't want to be boring you with these details and that much information. So anyways, let's jump right into it. So, from the recent news, you might have heard that Alphabet, the parent company of Google, got ruled that they do not have to sell from browser. So, this alleviates significant antitrust concerns. This news has propelled the stock to new highs, as you can see from the April 2025. It was $144. Now it's sitting around $233. So, it's important to note that while the recent legal victory is a significant positive, the ruling doesn't prohibit Google from entering into certain exclusive agreements, which could present some limitation on the future business practices. So let's continue. Here are some more information if you want it a bit more high level. So this kind of like tells you what's the story behind Google, what are their dominant and expand and how are they growing as well, and their ecosystems. This kind of tells you a story, and all of these parts are AI generated. So it shows you the bull case of Alphabet, the bear case, and the trend summary, which is Alphabet investment story, is one of the continuous trend in its core advertising business, coupled with significant growth potential in its cloud computing division. So, and you can read the rest. If you're interested, you can pause and continue reading the rest of this. All right. So before we actually start the valuation, I want to look at some, a good practice is to always look at financials for the company that you're planning on investing. So here we go. I'm going to be looking at quarterly. So first thing I want to look at is revenue, and while as you can see, they are growing. It's this steady climb like over the 10 years. It's fueled by the search engine, as you know, and it's fueled by YouTube, and cloud. But now the AI is basically making it mark. The reason we're looking at revenue because it shows how much money a company makes. And it's important because valuation model starts from revenue, and strong revenue equals strong foundation. And it's quite impressive, as we can see. And the next thing I wanted to look at was net income. Oh wow! So as you can see, they have been growing. So their trailing 12-month is a 115 billion, and you can see these small dips. And I believe it was due to slow down recovery and dips during ad concerns. And next thing, the reason we looked at net income was because it shows the actual profit after all costs, important for investors because only profits create real shareholder value. All right. So the next one we should be looking at is free cash flow, which is quite important. The reason free cash flow is important because it shows actual cash available for expenses and investments, and it's important for valuation. And you've seen these rapid dips within these free cash flow. They are due to AI and data centers and shares buyback as well. And I'm planning on adding some key metrics that might make it much easier to analyze stock. So if you have any recommendation, please send it my way. I would appreciate it. Thank you. And all right, so let's move on to the valuation portion. So before we start valuating, these are some of the parameters. These parameters are basically pulled from a Federal Reserve economic data, and it's used with stock historical data to calculate these certain values. And that's how they're already self-populated as well. Basically, risk-free rate is based on 10-year treasury yield. And as for the market risk premium, that basically captures equity risk premium amid AI optimism and geopolitical uncertainty. So we're also kind of keeping that in mind. And it's usually typically between 5 to 7%. Beta, I'm going to keep it as the same. This is multi-stage growth configuration. So if you wanted to look at the longer horizon time, and if anyone is interested, please let me know. So, and as for the behavior analysis, basically what this does is that anchors projections to history, not market euphoria. So this avoids overconfidence post of, let's say, AI hype is going on. So it gaps the assumptions near the 3-year average growth. In this case, for Alphabet, the 3-year average is about 13%. So this kind of calculates by itself and then compares it with Federal Reserve economic data that I pulled. So now let's move on to the valuation parameters. I believe I've already inputted them before. And all of these valuation that I've input before are based on the data that I've researched and I believe it to be that works for me. So like, for example, the conservative size it's below 3-year average because it accounts regulatory risks or add market slowdown. And as for the base case, it's kind of matches the Q2 2025 revenue growth and analyst consensus, reflecting steady ad or cloud growth. And as for the optimistic, it kind of captures the AI and cloud upside, tempered to avoid overhype of Waymo or AI bets. So that's how like I basically came up with this number based on the research that I did and the projections as well. So each one's gonna be different based on someone's opinion and based on since this was research and data driven, so that's why these are the number that I came up with. So let's run the valuation model. All right, so if you believe in the conservative numbers, then well, the stock is worth around $100. But if you believe in the optimistic, then it worth $283. But as for if you believe in base consumption, which are the normal case, then it's worth $166. And as for the PE valuation range, it's the same. If you believed in those, then these are the cases. So for the normal case, I believe for PE valuation is worth $232. So it needs to come by 28% if you believed in the normal case assumptions. And these are the 5-year projection based on the one I selected. And as for so let's look at sensitive analysis model. So this basically what it does is that it takes the growth rate that we input and then kind of compares it against the discount rate and says, hey, and creates a map and says, hey, like if you're thinking about the 20% growth rate and you believe the stock and we had this discount rate of 8.5, then it's worth $246, which has an upside of 5%. So it kind of gives you an easier visualization of that. So the moment you try to tweak a little bit of a growth rate or it kind of makes an impact. So this kind of gives you a bit more detail as well. And last but not least, so these are the historical growth analysis rate averages that I've calculated to kind of showcase anyone would be interested. So as we kind of gives you the formula of how it was calculated, so and the terminal value sensitivity as well. And sorry, I think I might have disabled the Yep, let's enable it. So this kind of behavioral analysis kind of shows you whether based on the Federal Reserve economic data, and it compares it with the stock data to say, let the user know that, hey, the assumptions appears to be optimistic in this case. Anyways, so while Google demonstrates strong growth, probability, and cash generation, current market price exceeds the fair value estimate by our discounted cash flow model. Behavioral analysis warns against overconfidence and narrow assumptions. So if you believed in any of the assumptions, and it's up for the users to decide. My point was to only provide you information based on the data-driven values. I would recommend to do your own due diligence, and I hope you have a wonderful day investing.